Thank you for joining us for today's Phillip Research morning call. Today we have a few counter updates. So without further ado, let me hand over this presentation to Ambrish who will talk about Airbnb.
Thank you, Darren, and good morning, everyone. So last week we published Airbnb second quarter update report. Overall, the Airbnb second quarter revenue, they were in line with the consensus estimates. However, the earnings per share, they beat the estimates by about 30%. In terms of first half performance, revenue and PATMI, they were at 44% and 27% of our FY 2022 forecasts. We expect profitability in the second half of the year to rebound strongly, mainly because of travel demand as well as higher operating leverage. Moving on to the positives. First of all, Airbnb's revenue, they were in line with the forecasts and they grew by about 58% year on year to $2.1 billion. The growth this was mainly driven by higher bookings volumes and continued strength in daily rates. The booking volumes, the second quarter, they grew by about 25% year on year to nearly 104 million nights and experiences booked. And this was mainly because of recovery in urban and cross-border travel demand, as well as improvement in business travel. Secondly, long-term stays, which is basically stays of more than 28 days, they remain the fastest growing category by trip duration as compared with the pre-pandemic levels of second quarter 2019. They surged by 25% year on year and by almost 90% as compared to the second quarter of 2019. The growth was mainly because of hybrid and remote work. Long-term stays, they account for about 19% of the overall gross bookings volume, and it is up from 13% in 2Q19. Lastly, Airbnb generated free cash flow of $0.8 billion in the second quarter and $2.9 billion in the trailing 12 months. The company also reported a record net profit, second quarter net profit of about $0.4 billion as compared to a net loss of $0.1 billion a year ago. Based on the strong performance, Airbnb, it also announced a share buyback program of up to $2 billion. And this should help the shareholders offset the dilution effect from the stock-based compensation. Moving on to the negatives. First of all, for the third quarter, Airbnb provided a soft guidance for its bookings volumes. Management noted that the bookings rate, they actually slowed in May and June due to higher cancellation rates because of flight disruptions, mainly in the US. However, the demand, they re-accelerated in July, and Airbnb, it now expects a bookings volumes growth of about 25% in the third quarter, which is similar to the year-over-year growth rate that was witnessed in the second quarter of 2022. Secondly, the bookings volume in Asia Pacific region, they are still behind their pre-pandemic levels. And this is mainly because of tighter government restriction rules for COVID-19, cross-border reliance, and closure of its domestic business within China. And if we exclude the Asia Pacific region, the bookings volume, they would have exceeded 2019 levels by about 35% in the second quarter. If we included, then the growth rate was about 24% overall. Moving on to the outlook, Airbnb still believes that the travel demand will be strong going ahead. For the third quarter, it expects to report revenue of about $2.78 billion to $2.88 billion. And this is a year-over-year growth of about 24 to 29% and 69 to 79% compared to the pre-pandemic level of third quarter 2019. Sorry. The adjusted EBITDA margin, it is also expected to be about 49% in the third quarter. Moving on to the valuations, we downgraded Airbnb stock to neutral from buy. This is mainly because the stock has run up over the last few trading sessions. However, we maintain our target price of $119 as our FY 2022 estimates, they remain unchanged. Overall, macroeconomic uncertainties, it could weigh on discretionary demand for travel, but we believe that Airbnb is a strong brand and it would still be a preference over hotels, mainly because it is a safer option as compared to the COVID-19 spread, also more affordable, and as the hybrid working environment, it is likely to boost the booking volumes for the long-term stays. I would now like to pass on to Jonathan for updates on Amazon and Apple. Thank you.
Thanks, Ambrish. So Amazon announced their second quarter results a couple of weeks ago. Overall, their second quarter revenue beat expectations, but earnings missed modestly. In terms of their overall first half performance, their first half revenue and normalized PATMI is at 45 and 38% of our full year forecast. When we mention normalized PATMI, we basically exclude the losses from other expenses. In terms of operating margins, they came in at 2.7%, down 4% year on year, and mainly just due to a lot of inflationary pressures. So on the positives, there were a couple. The revenue beat their own top end of their guidance. So revenue grew about 7% year on year, or 10% in constant currency. So there was a 3% FX headwind. This was mainly boosted by Amazon Web Services, or AWS, which grew 33%. But that being said, retail and advertising also did slightly better than expected, even throughout such a weak macro environment. The second positive is that the company is having good progress in adjusting its staffing levels and improving fulfillment efficiency. So it was able to work through some of its incremental costs, reducing it by about 2 billion quarter on quarter, so from 6 billion to 4 billion US dollars. Most of these costs include higher fuel, trucking, air, and ocean shipping costs. At the same time, staffing levels, which were quite an issue over the last quarter, were also more in line with the second quarter demand. So most of the overstaffing issues were resolved by the end of the quarter. Amazon is also seeing better optimization within its fulfillment network. So it's been improving its in-stock levels and increasing delivery speeds. On the negatives, we expect higher costs to continue, and this should hurt margins moving into the third quarter of 2022. So the company actually guided for operating margins to be in the range of 0 to 2.8%, with the expectation that pressure from high inflationary levels, higher energy costs, especially for their data centers, will continue to pull down the company's margins moving into the third quarter of this year. Strengthening US dollar is also expected to be a 4% revenue headwind. Overall operating margins, like I mentioned just now, we're at 2.7%, down from 6.8% in the second quarter of last year. The second negative was that Amazon actually saw a 3.9 billion pre-tax valuation loss from Rivian. And so it actually followed up a slightly larger loss in the first quarter of this year. And this pre-tax valuation loss resulted in the company posting a net loss of about $2 billion for the second quarter of 2022. If we kind of take this out and we take out the losses in equity investments, the company would have a normalized PATMI of about $3.5 billion for the quarter. So in terms of outlook, the third quarter revenue guidance by the company was quite positive. So the company is actually expecting revenue growth of about 13 to 17%, even with an estimated 4% headwind. So if you lump it together, it's about 17 to 21% year-on-year growth. One of the main reasons for this is that Amazon Prime Day is actually, or rather was held in July, so it was held in the third quarter of this year compared to the second quarter of last year. So you should see, or the company expects to see a big bump in revenue for this quarter, just mainly because of that one event. Amazon is actually still focusing on investing in AWS, Amazon Web Services. They're spending about 50% of their capex for the year, increasing headcount and infrastructure in new geographies. One of the reasons for this, obviously, is because it sees cloud services as a long-term lever and an industry that is a fast-growing industry, and it's an industry that's going to continue growing, for quite a while. It's also planning to build out its own pipeline for AWS bookings, which right now stands at about almost 4 years, I believe, but they're trying to make bookings extend out a little bit further so that they can better plan their investments. In terms of valuations, we still believe that earnings for this year will remain quite sluggish, mainly due to increasing inflationary costs. And so our full year FY22 assumptions remain unchanged. We downgrade Amazon to neutral with an unchanged target price of $133. So for my next company, Apple, they also announced their third quarter 22 results a couple of weeks ago. The third quarter 22 revenue and PAT were roughly in line with our expectations, with 9 months revenue and PAT at 77% and 80% of our full year 2022 forecast. Gross margins were at 43.3%, which was pretty flat year on year. They had a couple positives as well. There was record revenue from iPhone and services. Sales from iPhones grew about 3% year on year. And this was quite interesting because the company actually saw a record number of people switching to iPhones from other manufacturers. And Apple also mentioned that they didn't actually see any obvious macroeconomic impact on iPhone sales for the quarter. So very unusual, given that most other companies are mentioning significant macroeconomic impacts. In terms of gross margins, they were slightly above forecast. So their 43.3% was slightly above consensus, demonstrating its ability to manage some of their supply chain constraints better, especially despite COVID-related factory shutdowns in China and increasing FX headwinds. So products gross margin was down about 1.5% year on year, but services gross margin was up about 1.7% year on year. In terms of the negatives, supply constraints and FX are going to impact revenue growth moving forward. So Apple actually expects the supply constraints to continue, even though they do expect it to be at slightly lower levels compared to the previous quarter. And this should really affect product margins moving forward. They also expect a strengthening US dollar to provide about 6% negative headwinds for revenue growth. In terms of the outlook, they expect the fourth quarter 22 revenue to accelerate compared to the third quarter. They also guided margins to be within 41.5 to 42.5%, and operating expenses to be in the range of 12.9 to 13.1 billion US dollars. What's really doing well for them is that they're seeing a growing install base, and this is actually supporting their expansion in services. As more and more people kind of switch to iPhones or just general Apple products, and you get this base of customers that are able to that you can leverage on to kind of use their services, and that's where they generate and how they generate expansion in services revenue. In terms of valuations, we adjust our full year 22 PATMI upwards slightly to reflect higher gross margins, and as well as the outperformance for the first half, or rather for the 9 months of this year. We maintain a buy rating with a raised target price of $198 from a previous target price of $194. So that's all for me. I'll pass my time on to Glenn for DBS. Thank you.
Thanks, John. So for DBS, we will just do a brief summary of their second quarter earnings. The second quarter earnings of 1.82 billion were in line with our estimates due to higher net interest income, which was offset by lower fee income and other non-interest income. The first half 22 PATMI is at 47% of our FY22 forecast. The second quarter DPS is also up 9% year on year at 36 cents. So I'll jump straight to the positives. The first positive is that the net interest income grew 17% year on year to 2.5 billion due to net interest margin increase of 13 basis points year on year to 1.53% and continued loans growth of 7% year on year. Loan growth was mainly driven by trade and corporate non-trade loans, while housing loans and wealth management loans were little changed. The net interest income margin improvement was mainly due to the rising interest rates as the impact of interest rates hikes were more fully felt. Management has lifted their NIM guidance to 1.7 to 1.75% for FY22, and this is from previous guidance of 1.58 to 1.6%. The second positive is that their second quarter total allowances were lower year-on-year and quarter-on-quarter, mainly due to lower specific provisions of 69 million, and this was compared to 167 million in the first quarter. Furthermore, the credit costs improved by 6 basis points year-on-year to 8 basis points. And the general provisions write-back of 23 million for the second quarter was from credit upgrades and transfers to NPA. Their GP reserves also remain prudent at 3.74 billion, with NPA reserves at 113% and unsecured NPA reserves at 199%. The NPL ratio was maintained at 1.3% as a new NPA formation remained low. For the third positive, loans grew 7% year-on-year and 1% quarter-on-quarter to 425 billion. This was mainly driven by trade and corporate non-trade loans, while housing and wealth management loans growth was sustained at the previous quarter's levels. Management, however, has lowered its full year 22 loan growth guidance to mid-single digit, and this is from the previous guidance of mid to high single digit. Deposits grew 9% year-on-year and 1% quarter-on-quarter to 528 billion, and the current and savings accounts, or CASA, accounted for 72% of customer deposits. For negatives, there's one negative, is that fee income declined 12% year-on-year, and this was mainly due to weaker market sentiments affecting the wealth management and investment banking sectors. Wealth management fees fell 21% year-on-year to 337 million as market conditions further weakened during the quarter. Investment banking fees fell 54% year-on-year to 30 million, alongside a slowdown in the capital market activities. Nonetheless, their credit card fees improved 23% to 203 million as borders started to reopen and spending increased, while the loan-related fees moderated from record levels. Other non-interest income fell 10% due to less favorable market opportunities. For the outlook, despite economic uncertainties from macroeconomic factors such as slower growth, higher inflation, and supply chain disruptions, loans and transactions pipelines are expected to be strong. Management has also said that stress tests of vulnerable sectors and countries reveal no imminent areas of concern. For its GP reserves, we believe that the bank has sufficient provisions to ride out the current economic uncertainties, with its capital position and liquidity well above regulatory requirements and high allowance reserves. Their CET1 ratio improved 0.2% quarter-on-quarter to 14.2% and is at the upper end of DBS's target operating range. Lastly, for the interest rates, management has said that it expects to end 2022 with an exit NIM of 2%. They've also reiterated that a 1 basis point rise in interest rates could raise their NII, or net interest income, by 18 to 20 million. Hence, we maintain our buy recommendation with an unchanged target price of $41.60. Now I'll move on to OCBC. So for OCBC, their second quarter earnings of 1.48 billion were in line with our estimates, and this is mainly from higher net interest income and non-interest income, along with lower allowances. The first half PATMI is at 47% of our full year 22 forecast. Second quarter DPS rose 12% year-on-year to 28 cents. So for the positives, the net interest income grew 16% year-on-year, led by loans growth of 8% year-on-year and net interest margin improvement of 13 basis points year-on-year to 1.71%. Loan growth was driven by Singapore, Indonesia, Greater China, USA, and UK, and in the building and construction general commerce sectors, as well as consumer lending, including mortgages. Net interest margin expansion was mainly due to asset yields outpacing higher funding costs amid a rapidly rising interest rate environment. OCBC has guided for mid-single digit loan growth, and this was previously from mid to high single digit as well as a NIM of 1.7%, up from 1.5 to 1.55% previously. The second positive is that total allowances fell 69% year-on-year, but were up 64% quarter-on-quarter to 72 million. General provisions of 66 million and specific provisions of 6 million were made during the quarter. Total NPAs were down 8% quarter-on-quarter and 3% year-on-year to 4 billion, and the NPL ratio improved by 10 basis points quarter-on-quarter to 1.3%. Credit costs also improved by 22 basis points to 8 basis points due to the better credit environment and write-backs in Malaysia. For negatives, there's one negative, is that fee income declined 15% to 477 million, mainly due to the lower wealth management, brokerage, and investment banking fees. And this is in line with weaker investor sentiment globally. Nonetheless, their loan and trade-related fees increased on the back of higher lending and trade volumes, and credit card fees were also higher during the quarter, in line with the broader reopening of economies and resumption of activities. Trading income also increased 26% year-on-year to 267 million, mainly from higher customer and non-customer flow of treasury income, while insurance income increased 82% year-on-year to 372 million due to an increase in operating profit and mark-to-market gains. On the whole, non-interest income saw an increase of 6% year-on-year and 3% quarter-on-quarter to 1.18 billion. For its outlook, loans grew 8% year-on-year in the second quarter, and this was exceeding the bank's guidance of a mid-single-digit increase for full year 2022. However, management has said that it expects continued economic growth, but at a slower pace due to the current economic environment. For China, OCBC's total exposure to mainland China remains at 11% of group loans at 34 billion, with onshore exposure at 7 billion and offshore exposure at 27 billion. Nonetheless, customers include mainly top state-owned enterprises, large local corporates, as well as OCBC's network customers. Less than 1/3 of the group's mainland China onshore exposure, which is about 2 billion, is corporate real estate loans and is largely lending to the bank's network customers. The Greater China NPLs remain relatively unchanged and rose by 4% quarter-on-quarter to 631 million. Management has raised its NIM guidance to 1.7%, as previously mentioned. It expects to end 2022 with an exit NIM of 1.8%. And OCBC has also said that based on historical data, 100 basis points increase in rates would lead to an 18 basis points increase in NIMs. As such, we maintain our buy recommendation with an unchanged target price of $14.22 for OCBC. So that's all I have for the banks. I'll now hand it over to Paul.
Thanks, Glenn. So move on to first sponsor. I don't cover this stock. It's actually done by Terence. He's away, so I'll just give you some highlights. Just as a refresh, first sponsor is partly owned by CDL and also partly owned by Tai Tak Estates, which is one of the major shareholders of UOB Bank. The three main business for them is property development in China, as you can see from the table on the left. The other business is actually property holding, which is actually a group of European hotels and offices that they own, namely in Netherlands, and also property financing, which is basically money lending to developers. So in terms of the positives, I think the property holdings came in better because of the recovery in hospitality in Europe. The other thing was that housing policy is beginning to improve in China, especially in Dongguan. Just to give you explain what they mentioned. So in Dongguan, unlike in Singapore, property restrictions there is not higher stamp duties like we have here. It's totally outright you cannot buy. So right now they've actually been relaxing it and allowing even non-local residents to start purchasing, and that's why this relaxation in property measures has seen a rebound in property sales in Dongguan. Other things which will be, they had one loan that was defaulted, but the recovery is underway, and also they are also disposing one of their malls in Pudong. Next slide. The negatives was they have a development in Guangzhou which only has been 11% sold, so the restrictions are still on there. So to move the market, you really need to for the cities to kind of relax their property measures. They also have there could be a potential impairment on hotels in the second half for them. it's a bit strange, although the RevPAR is rising, but they just worry that because the discount rates or interest rates are rising. So, when you do a DCF, the higher discount rates or interest rates may actually cause the valuer to maybe pull down a bit of the valuations. But just as a side note, interestingly for them, they prefer office assets in Europe, because in Europe, all the rents are pegged to inflation, which is the CPI, and then now CPI can be 7, 8 to even 11%. So by default, their European hotels will all get a big jump in rents. The other curious thing that they mentioned was also hospitality, which is hotels. So they have a contrarian view a little bit. So they're just a bit worried of hotels in Europe. Firstly, because energy prices just jumped 5 times. And they're also a bit worried that because hotels is essentially still a discretionary item, a discretionary spend. So they're just worried that if room rates continue to rise and if Europe, the uncertainty persists, that could be, hotels may not be as strong as people expect. I mean, this is an interesting comment considering that they are not partly owned by hotels which own Millionaire and Coptham. In terms of the outlook, the property appears to be beginning to see some green shoots, very dependent on government policy, strong balance sheet. The other thing that they mentioned in China, which is their property financing business. So what they do is they actually lend money to a lot of the developers. All these are collateralized, but they say that the business there won't do well because because the banks are lending again to developers and lending very aggressively. So that's why, which is a good thing for the property market, but negative for them because there'll be less the borrowers. So the borrowers are all repaying because the banks in China are beginning to lend again to developers. Next slide. So for ventures results, riding on, can you go back to the, yeah. So for us, for ventures results, what is happening is that they are basically riding on the easing of lockdowns and also improving supply chains that's going to help the business for this year. Next slide. So just as a reminder, maybe we mentioned this before, but when you go for a venture analyst briefing, 50% of the time is like an English lesson, because any questions you ask, they ask you to refer to their outlook statement. 40% of the time is actually like a history lesson. They'll tell you how good they've been, and 10% of the time is really asking us to clap for their results. But anyway, so don't expect much from them when they send results, but just give you our note. For the results, was within our expectations. Second quarter did very well. They jumped 20%. In terms of the positives, the customer demand is not on the slide, but they mentioned that all their sectors did well. So we see robust customer demand across all sectors, and can be telco, medical, all the verticals. I think they have 12 or 8 or 9 verticals or sectors. So this actually means that you could see the demand continuing because every sector is doing well. So it's not like skewed towards 1 or 2 sectors. And demand continues to be unmet because of the supply chain challenges. And also the revenue for June was actually the second highest on record. In terms of the negatives, the big negative, at least financially for us, was the effective tax, which used to be 13-14%, but now it's jumped up to 18%. Although they didn't really explain why, but we think it's because they mentioned it was due to lower tax incentives in Singapore. One possible reason is because which is a good thing too, they've actually been cutting a lot of capex and R&D. So maybe that's one of the reasons why they've got less capex, less incentives. I mean, mainly on the capex, of course, that's the positive thing. In terms of the outlook, we think venture is coping well with the supply chain constraints. And they better be, because the second quarter they added almost 400 or 500 million of inventory. So they got almost like 1.25 billion of inventory to cope with the supply chain. They used to be maybe 600-700, but now it's almost a 1.2 billion. So with that type of inventories, you should be able to cope with any supply chain challenge. But we think FY22 will be a recovery year for venture. They continue to emphasize that the demand is healthy and unabated. So that was our English lesson. The focus is on unabated. So demand momentum should continue to second half. Especially last year, they had the disruption when the factory shut down in Malaysia. So you could expect second half, at least year on year, you're going to be a big jump because last year there was almost a 1 month of disruption. So we maintain we leave our earnings, our target price a little bit to $20.80. The demand, the dividend right now is healthy, about 4.5. If you look at the dividend, they didn't raise it even though earnings was better. They just mentioned that just to be conservative because COVID is still out there. Anyway, blah, blah. Next slide. For Starhub, the results actually was better than expected, but we think, like the title suggests in the previous slide, there'll be more costs ahead for them. Next slide. In terms of the results, so first half, the EBITDA, mostly we work on EBITDA because we do our valuations on EV/EBITDA, so it was 36%. So it really beat our for earnings, but nevertheless, we think the margins will contract very severely in the second half. Just as a reminder, Starhub is undergoing a major revamp in their cost structure. So they're going to invest a lot in their IT outsourcing and EPL content and so forth in order to get new revenue streams. I think this was messaged already in February, but the impact you will see more severely in terms of more costs that will happen in the second half. So in terms of the first half, performance that we mentioned exceeded management guidance. So management will guide for the year, revenue at least 10%. You can see from the chart here is already 12%, EBITDA margins, everything, CapEx, all of them beat. Dividends was within their guidance of 5 cents. So that gives them a dividend yield maybe 4.5% right now, assuming 5 cents. The negative is the operating costs you beginning to climb, and you should expect it to be even more severe. So some of the things that I think we already highlighted, IT outsourcing, licensing, utilities, of course, and so forth. In terms of the outlook, the worry was just that the management didn't change their guidance. So this implies that you're going to see a big dip in margins from 25% to 17%. Due to like all the reasons we gave. So unless roaming revenue rebounds, right now roaming revenue is improving. But the problem is that unlike the pre-pandemic, you don't have the China travel roaming revenue, and also corporate travel hasn't returned. So all this is just holding back a full-blown growth in roaming. Roaming, we estimated pre-pandemic was almost 40–50% of earnings. So it's a very big contributor because roaming is pure profit. Because when a customer from Malaysia come here, there's virtually no extra cost for them. So it's pure profit business. So we maintain the accumulate with unchanged target price, but admittedly, mainly our accumulate is mainly on the for valuation reasons. But earnings momentum will be pretty sluggish for the second half. Next slide. So for Raffles Medical, as the title suggests, the earnings was very strong. It blew away our forecast. Maybe as usual, maybe our numbers were all, my number was actually all wrong, I guess, due to foreign reserve patients and electives. Next slide. So in terms of the first half, their profit was 95%. So their first half profit was our whole year's forecast. Hopefully nobody noticed that. But so one of the reasons why they beat was because foreign patients came back strongly, especially from Indonesia. The other big thing was the return of elective treatments. So when the pandemic happened last year, actually the authorities also kind of hold back, also discourage our elective surgery because the focus was treating the COVID-19 patients. And also there was more resilient COVID-19 revenue than I had expected. In terms of the positives, the revenue grew, expanded 11%, despite PCR testing and so forth. You can see from the left here, the total revenue in bold was up 11. Operating margins rose, and the revenue in China also grew despite the Shanghai lockdown. But Shanghai is just a new hospital, and the free cash flow was very strong. But just go back to the revenue line. What happened was that the other thing that benefited was the more people visited the GP clinics. That's why you see the hospital healthcare services did well. And also the COVID-19 was resilient because they got higher patient load at the CTFs, the COVID-19 treatment facility. So for those who are not familiar, CTFs, because of the government authorities was worried there'd be too many COVID-19 patients. So they set up these treatment facilities. It's like almost like a hospital, but it's catered mainly for the elderly with COVID-19 symptoms. which maybe sometimes might need monitoring and maybe a bit of oxygen care and so forth. So for the outlook, we expect second half to be resilient. I mean, supported by the same reasons again. The additional thing in the second half is that they might actually raise prices, which they haven't because of all the cost increase. The revenue track, which is a bit will come from the lower COVID-19 services. And we think even though China is still suffering losses, but they actually performing very well considering China is probably like a 10 million EBITDA loss, maybe full year could be, net loss could be maybe 15 million, 20 million kind of loss, but they still managed to perform well for because of the Singapore passenger load. So we raised our earnings by 60%. The unknown for us, whether our forecast will be hopefully this time more accurate, it's just the uncertainty and the lack of visibility for COVID-19. So we're really not sure if the cases really drop down a lot, then they may not have so much CTF to business, and that would cause the big swing in our earnings. So we upgrade our target price and raise our recommendation to buy. Next slide. I'll go through our usual weekly. Next slide. So for Singapore, some of the key macro data points for Singapore, retail sales in Singapore is very strong. A lot of people are out there shopping. Just to give you a flavor, retail sales excluding motor vehicles, we take out motor vehicles because motor vehicles very volatile. It will cause huge swings in the numbers. But even then, retail sales in June was up 20%. Pre-pandemic, retail sales in Singapore at best would be 3%. So you are like almost 10 times faster growth than pre-pandemic. Some of the areas doing well, you can watch. I'm not sure who's buying all this, but apparel, watches, supermarkets are weak, as highlighted in the Sheng Siong results. So there's basically like a revenge spend, discretionary spend, especially by Singapore consumers. There was some manufacturing data, the PMI survey, it continues to be weak. It was 50.1. So this is a survey. So above 50 means it's expanding. This is one of the lowest readings over the last 2 years. So manufacturing is slowing down in Singapore. Construction activity, nothing much, a bit of slowdown in contracts awarded. But as what Penn United mentioned, they're having a lot of disruptions in the construction sites, mainly because number one, there's dengue is causing a lot of disruption. Number two, a lot of workers that were here during pandemic the last 2 years now are going back. So even though there are more workers coming in, there are also a lot of workers leaving. So that's why the workforce is still not back to pre-pandemic levels, and that's causing a bit of slowdown in construction work and also what. The US data, I think we all saw in the newspaper. I won't run through, but what it means for us is that there's wage growth of 5% and also jobs growth. So it means aggregate demand, that means total demand is actually very strong in the US. So in terms of our tactical view, we think it's still a sweet spot for the banks. High interest rates means higher net interest margins, and then we have a very benign provisioning cycle. So provisioning cycle means we have very little bad debts in this cycle, especially in the regions like Malaysia and Indonesia. And we think, so right now for the short-term trade, I think for us, there could be a trading window on inflation data, because the big news to watch that will dictate the market direction is, of course, the CPI number coming up in the 10th of August, the one in red at the bottom. Now, but we do think that there should be signs of inflation rolling over, that means coming down. And there should still be some rally, although we don't think it will sustain, but there could still be some short-term rally for the Fed pivot short-term rally. We should a chart later. In terms of the webinars for this week, in green, we have Asonic, which is still trading below their net cash. Next slide. So for this chart, this is just the retail sales. So if you can see it's now about 20%. If you look at the 2014 to 2018, you can see that usually sometimes most times Singapore retail sales is negative. So this reading of 20% is like exceptionally strong. This one is nothing but just to show you that although awards are down, but the contracts are being awarded, so there's still work being done at still healthy levels. Next slide. In terms of the wage growth, so what we're just trying to emphasize here is that although the US GDP, the headline was negative, like technical recession, but in terms of nominal terms, that means in actual value terms, the US GDP was, I think, up 11%, I think, or 9 or 11% for the second quarter. It's just that because you have to adjust for inflation, it is actually negative. So what we're trying to say is that the aggregate demand, that means demand from consumers, will still be strong because consumers are having wage growth, which is around 5%. And they're also having more jobs, plentiful jobs. So consumer demand in the US should still be strong. Why we think CPI, the chart on the right, why we think the CPI rate should be coming off is that if you look at CPI, which is the inflation in rate, it tracks very closely with commodity prices naturally. But you can see that commodity price in blue has started to turn. That means although it's still expanding, it's still growing, but it started to come down very sharply. So we should expect, I don't think it will drop so much, the CPI, but we should expect the CPI to start rolling over, and this could be a trigger for maybe a short-term trade in the market, a bullish trade, I guess. Next slide. Okay, this is my last portion here. Sorry, second last portion. It's just on Wilmar's, Phillip on the ground. Nothing really earth-shattering in the meeting, but in the table on the right, you can see that all the divisions did well except food products. So as a reminder, what Wilmar has, food products is like edible oil they sell in China. Feed is basically soybean crushing they do in China, and also palm oil processing. Plantation is basically the selling. They have plantations, especially in Africa. They sell, and then they did well because palm oil price was up. The food didn't do so well because actually inside here there's a 175 million gain from when they listed Adani Wilmar in India. So if you take that out, actually food is down. Feed did well, it grew, is better because of the soybean crushing. Plantation, of course, palm oil. I won't go through most of this, but in terms of the buybacks, they will continue to do share buyback because for them, their 44% stake in Adani Wilmar listed in India is worth 4.5 billion US. Their Yihai Carry listed in China, they own 90%, is worth 30 billion. So to them, these two businesses is worth more than their whole market cap right now in Singapore of 27 billion. But of course, a word of caution, both of these stocks only 10% free float. And also, in a way, it may not truly reflect the true market price because it's only 10% float. But anyway, they will want to do buyback because they say that it's cheaper than even starting a factory because the price is so cheap. But anyway, in terms of the outlook, they still hope to maintain performance into the second half because crush can improve because we think the hard livestock is rebounding and consumer packs will benefit. That means edible oil they sell to consumers because the prices increase, but there'll be a lag before you can recover the margins. I think they were a slightly more cautious, I think, from my own reading, is for the second half, is because just as a for Wilmar, they depend a lot on market timing. So if you look at the timing bullet point here, when you do refining margins, that means when you buy palm oil, refine it and sell it, your margin is probably only 10% because there's a lot of capacity. But your raw material can swing $100, $200. So the key for them is the ability to time, to read the market well. So that will be the thing that will determine second half, which is not impossible for us to forecast or anyone to forecast. Next slide. So we just have a quick look at some of the data that might affect Wilmar. So you can see from here, this is the number of hogs or pigs that are being livestock in China. And you can see that because of the swine flu, it dropped a lot, but right now it bounced a lot, but recovered strongly. And this will benefit soybean crushing because what Wilmar does, soybean crushing, is they will buy the soybean, crush it as meal, and then sell the meal as feedstock for the hog farmers. The right is just a proxy to the oil price, edible oil price, which is the premium oil price. So you can see that prices continue to climb, and they should benefit the Yihai Carry. Margins should recover as the cost of materials come down. Next slide. We also just wanted to look, since like we heard earlier mentioned, first sponsor mentioned that property is recovering, is slowly beginning to recover in China. So when we look at Yanlot's numbers, because they announce monthly pre-sales, so if you look on the left, you can see there's a big rebound for pre-sales for Yanlot. Again, this is only one or two data points, may not be for the whole sector, but at least we can see that April and May, property sales was probably one of the worst. But you can see that in June, July, it's rebounded very strongly for Yan Lot. Likewise, you look on the right, which is more a calendar chart. 2021, they were actually above. Then the last 2 months was really bad. I virtually couldn't sell much. But then you can see that June, July is recovering, which we think, firstly, because the governments are relaxing and also the banks are also providing more loans to developers. So this should help the recovery. Okay, next, I think that's it. You can move on to questions. Thanks.
Thanks, Paul. I think I'll just take one of the questions first regarding the banks. Just let me read the question out loud. Hi, Glenn. As the 3 local banks have reported their earnings, which bank would you think performed the best, and which of the 3 you think offers the best value going forward, please? Okay, so I would say OCBC. I mean, all the banks perform quite well. I think OCBC performed just marginally better than the rest, mainly due to lower allowances. So all 3 banks had higher net interest income and lower fee income. So that is quite similar across the board. But OCBC had lower allowances because they recovered from previous quarters when their allowances increased mainly due to hits taken in the Indonesian and Malaysian economies. So they had lower provisioning for this quarter as well as the first quarter of this year. And also their net interest income grew, I would say, one of the largest to the 1.71%. So theirs is, I think, the highest amongst the 3 local banks as well. And which of the 3, okay, so the second part, which of the 3 you think offers the best value going forward? So I think that will also be OCBC. And it is our preferred pick, mainly due to, I would say, several catalysts, including lower provisions and higher interest income as the economic conditions improve. And it's our preferred pick among the 3 banks, mainly due to their attractive valuations, the upside in dividend, because their CET1 buffer is the highest. It's still the highest amongst the 3 local banks. So at 14.9%, and as well as lower provisioning as the Indonesian and Malaysian economies recover. Okay, let me look through. I think that's all I have for the banks. I'll hand it over to the rest of my colleagues. Thanks.
Yeah, thanks. Yeah. Okay. Let me just try to answer some. Any insight why share price of Wilmar dropped a lot today? My only guess is that they didn't sound exceptionally bullish for the second half. They just said that they will try to repeat the performance in the first half. So I think that could be a reason. And I think I think we still like the stock, although we don't cover, but I think the operating conditions are still healthier. Yeah, but just that the outlook usually, not because we've been to like I don't know how many years of his briefing. Usually he tends to be a bit more bullish, but this time around maybe the reading of it might be a bit more cautious because maybe he's just a bit more worried of the operating conditions. But yeah, I think that was what happened. We thought he would be a bit more bullish about, yeah. Again, this is very subjective. There's no number for it, but any drop in the share price, I think it can be quite attractive. Yeah, for me at least. Why do you think the rally is not sustainable? I think the rally is sustainable in the short term. Just in the long term, if the market is just rallying because it's a Fed pivot, I'm not sure. Fed pivot. Okay, what we're trying to say is that the market is rallying because they think the Fed will cut rates, which I don't think they will. I think inflation will start to come off, but it will still be very elevated. So that's the main reason why I think longer term the rally might not sustain unless we see the data really improving. Yeah, what I like highlight before, again, this is a bit more nuanced, but I just want to see like core CPI start to come off month on month. Then we know there is at least visibility. So I don't think the visibility we are getting from the Fed is real because it's still depending on inflation data. But in the very near term, I think you won't see inflation. It will start to drop off but then the market might just use this as a rallying point, but it might drop a little but then it may still stay very high. So it's all about inflation now. Yeah. Yeah, I hope that helps. Yeah. Again, this is all very short-term reading. Yeah. Paul, your views on Yangzijiang shipping in the next 6 to 12 months. Okay, for Yangzijiang, operationally they will do well. Number one, because their order books is filled up to 2025. So anybody want to order ship now, you have to get only delivery in 2025. Number one. Number two, the earnings will be very strong because the margins now is a bit softer because what they're delivering now, the 35 ships in the first half, is mainly orders that they got 2 years ago when they were a bit more desperate for jobs, right? So the margins is a bit lower. So moving forward, as they deliver those orders that were done maybe 1 year ago and plus, you will see the margins rebound very strongly. But having said that, the problem is still the share price because, you know, people buy Yangzijiang shipping because they want to play the shipping cycle. So again, I'm really not sure whether share price performance wise, how good it will perform. That one I'm really not clear, because if people see the shipping cycle coming down, then they will know eventually because when you buy all these stocks, you're buying the order book, you're not buying the actual results. By the time the actual results are good, it's really time to sell the stock. So I'm just a bit worried how the market will read if the container ship rates start to drop, although it's only dropping a little bit. That's my only worry. So I don't have like a firm view on this. Yeah. Not sure if you follow Franken. Any comments? Also, is Franken similar to Franken? I don't really cover. I only met them once in I don't know how many years. Franken is a bit more semiconductor centric. Yeah, they do a lot of things. They won't do plastic. They are a bit similar to venture because they do every single thing possible. But the only thing is that they are a bit stronger. They are more focused on semiconductors. So they should be doing well. But again, sorry, I'm not really good in Franken because I never really met them. So don't have a good answer for that. Sorry. What's your view on Del Monte? Thanks. Yeah, we still like the Del Monte. The stock is very cheap, 5 times PE. The dividend yield, I think, value now 5-6%. And also the products they are selling, as a reminder, it's like canned food, food in a cup. So these are a bit less discretionary. These are more consumer staples. So we got no change in our recommendation for Del Monte. Yeah. Although we are the only person covering the stock. Yeah. Although it's 1 billion market cap, not sure why. Yeah. To share Singapore job and wage growth. Yeah, I think Singapore wage growth is about 4-5%. Yeah, something similar to. So maybe that's why you see everybody out there shopping. I'm not sure. Yeah, but we will try to share it because Singapore jobs is normally once a quarter. So we do it, but usually only on a quarterly basis. Glenn, you want to take some first? Yeah. And also, Darren, can you help out on the European REITs if you could?
Thanks, Paul. I think I'll just take there's one more about OCBC. So the target price of OCBC reflects how many basis points interest rates hike forecast by the US Fed going forward. So the target price, actually, there's a lot of nuances that go into how we derive our target price. So it's not really based just on the rate hikes by the Feds, but talking about the rate hikes, so it will affect the NIM. So our NIM forecast is 1.69%. So I mentioned earlier that OCBC's second quarter NIM is 1.71%, but their total NIM for the first half of the year is actually 1.63%. So we expect about another 0.06% or 6 basis points improvement in their NIMs. Yeah, and this actually pegs very closely to OCBC's guidance, their management's guidance of about 1.7% of the full year NIM guidance for 2022. I hope that answers the question. I'll hand it over to the rest of my colleagues.
I think for the European REITs that listed in SGX, right now there's only a Cromwell, which is a pure European REIT, and so as iREIT, Elite Commercial is more of UK. So for the target price and all these, we do not cover. So yeah, we don't really have much of a view for that.
Okay, thanks. Let me just move on to the next few. But having said that, I think for us, I think European REITs do look attractive because their rents are protected, and the sentiment is obviously very poor on Europe because of the euro, and also there is a war there anyway. So it may look attractive, isn't it, if you're a bit of a contrarian, because there is protection from on any inflation you have to worry about. Actually, they benefit from inflation because they never had got much rental reversions, because inflation in Europe was always maybe 1-2% at best. Rent now is jumped maybe, like mentioned earlier, 7, 8, 9, 10%. Yeah, so they will get the benefit of it, and it's a bit more contrarian because people just worry about recession, and after all, there's a war there. So I thought it looked interesting in that sense. Any updates on MM2 Asia? There's really nothing much from us. Let me just try to get them on for a webinar, then maybe they can share with everyone. The last time, again, it's the same update that we had when they had the deal. They technically have already sold the cinema. So if the worst case, they can if they don't do the listing and so forth, they actually sold it for, I think, 90 million. I'm just taking off from memory. Sorry if it's not correct, but so the cinema operations is technically already sold with a minimum price of about, I think, 90 million. But there's really no new updates on MM2 because they didn't even give a briefing, although we do meet them. LHN ISDM prices keep falling. Your update. We really don't have anything on ISDM. Don't really cover. But for LHN, it still should be good, because if you look at the rental index continues to climb up, and they will benefit from Kolivu, which is their co-living. So co-living is kind of a sweet spot, like we highlighted before. It's between renting a room every day, so they got very flexible. You can rent for weeks, you can rent for months. So it's better than taking a long-term lease. You want to rent a home for 3 years or yeah. So that part of the business is still doing well. So really no new update for LHN. Hypo, any interesting stocks for the month? Although I don't cover China, but I would think maybe Chinese property names might be interesting, I thought, because the sentiment is really so bad. Of course, not those that have bankrupt, that have liquidity issues, but if the Chinese banks are lending again, and if the cities are going to reopen or lift property, they are very draconian property measures, I think there could be upside for Chinese property stocks. I mean, that's my own thinking, although I'm not an expert on this area. What's your view on commodity and oil? Again, this just general comments. You probably can get it from better commentary, but I think it will probably be a bit sluggish for now, until maybe the year end. That will be the real test, because that will be when you enter a winter period, and then that's when Europe will stop buying Russian oil. I think that will be the real test, whether the commodity price will rebound sharply. And of course, if China's property market is coming back, then reopening, which again nobody really knows. Some argue that it will not happen, some argue it will, because it could be their ideology to have zero COVID. But maybe by year end you have a better clarity. I think right now commodity would still trend downwards, because the global growth is slowing down. So the swing factor will be the winter, and also how China lifts their property measures, how China lifts the economy, and also the lockdown measures. If overnight there's news of that, then you probably will see a big bounce in commodity. Again, this is my amateur view. Is there any reason for Suntec, you want to give it a try that.
Yeah, so for Suntec, the poor equity performance we think is basically because of the macroeconomic factors right now, like the interest rates are rising, so that's generally not a good thing for REITs. But for Suntec, there are some good points as well. Like we think that the reopening of their convention center and the retail space, like generally the retail numbers are already better than pre-COVID levels. So there are some good points for Suntec as well, even though we do not cover.
So for so for REIT, I mean, just to top on what Darren said, which is our new REIT analyst, testing of Suntec is the high beta way, like we highlighted before. It's a high beta way to play the hospitality, the reopening sector, because not all, I think none of the REITs have convention center like Suntec, which are obviously going to recover, which we highlighted, I think maybe 1 or 2 weeks ago. And also they have it's a bit more tourism in terms of the spending, not as high as Orchard, but it also they have more atrium sales and so forth. So for us, I mean, though we don't have coverage, but we think Suntec is an interesting thing if you want to play on the reopening. Because they're not like other REITs, maybe a bit more bond-like, because everything is kind of fixed and a bit rental growth is sluggish. I think the problem for Suntec, the big drop was because amongst all the REITs, their hedging was one of the lowest. So I think that's why the market slowed down on it. But if you want to buy something on reopening, I think this would be the one, better than buying a suburban REIT, which already did well. So there's really not much room to grow. But if there's a rebound, especially next year when they take full 12 months of reopening, Suntec REIT would be the one. What's your view on SETS and SIA Engineering? Okay, for SETS, we were initially optimistic on SETS because reopening, right, is like a no-brainer, number one. And number two, it was an easier way to play because SETS there's only in Singapore, there are although they don't call themselves a monopoly, but got 90% market share. So it's a really big or super strong oligopoly. It was like buying an airport, but the problem for SETS was that they had to take up a lot of costs. We were a bit surprised, we were a bit surprised that they had to take up a lot of headcount. So they had to pull in a lot of people for their hotel, for their food, for the hotel operation, for the airport operation, before the reopening. So we think the earnings is going to surprise on the downside for the next couple of quarters. Because they had to ramp up all these headcount costs, which again jump up, and then I'm not sure how good they have. They never disclose, but their biggest customer is SIA. I don't think they have much pricing power with SIA. After all, there's a parent, right? So I think this stock might take a few quarters to recover. Then you might see the big rebound. For SIA Engineering, I didn't go for the briefing, so sorry, I don't have much to comment on that yet. Yeah. Paul, what's your view on Yang Zhejiang Financial Holdings? Okay, for Yang Zhejiang, it's more like a valuation call for them. We think when they release the results, you're going to see very strong net cash. They could be trading at net cash. It all depends on them. But earnings is going to be very weak for the next 1-2 years, because what they've done is they brought their assets from China, bring it down to Singapore. But assets in China is, the yield is so much higher, right? Compared to when they bring the money down to Singapore, they're going to start a PE fund and so forth, which the earnings is going to take a long time, maybe 2 years' time. So it depends how the market reacts. This time I'm just trying to guess how the market reacts. So they have to keep very high dividend and also show that they are very... So it's more a valuation call than earnings growth. But there's really no... you can assume there's no earnings growth for Yang Zhejiang Financial, although the results hasn't come out. But so this one is it's a bit hard to call because it depends how the market view and how they want to push their dividend. So if the dividend yield is strong, then maybe this stock is worth buying into, because they will be paying high dividends until the Singapore operations rebound. Yeah. So really don't have a really straightforward answer, but this is just how I think of it. Okay. What's your view on SSB? Apologies. Singapore Savings Bond. Oh, okay. Yeah, I think maybe wait a few more, maybe at if this is Singapore savings one, I think maybe wait a little bit longer, maybe wait at year end, because I think interest rates will still continue to climb. My own our thoughts are that the Fed will still the Federal Reserve will still raise interest rates by another 100 basis points or 1 percentage points. Then maybe you can anchor your portfolio with a higher interest Singapore savings one. Again, this is just my own thoughts. Yeah, because right now, because interest rates will still climb. Yeah, I don't think it's still the end of it. Yeah, that's what I think. Darren, you want to help out on some if you can? I'm not sure. Yeah.
Yeah, so there's a question, will Escort REIT hotel business be cautious similar to first sponsor? So for this, Escort REIT actually, the first half results were actually quite good. Like the RevPAR is 82% of pre-COVID levels already, and it's expected to maybe even be higher than pre-COVID levels by the end of this year. So, but there's some downside is the China and Japan is not yet open yet. So occupancy is still quite low there. So in all, will the business be cost similar to first sponsor? Is kind of similar because I believe first sponsor also has some China hotel assets. So it's kind of similar in the way the occupancy is. Yeah. And then another one is Yanlot and Capital CCT affected by the current property problems in China currently? So this one, I'm not sure, maybe Paul can answer the Yanlot part, but for CCT, we do not have much coverage, and CCT is more of a REIT, and so it's not as affected as the other property developers in China. Because after all, as a REIT, it's more of a retail space. Yeah, so also this one Paul can help. Thanks.
Yeah. Okay. Thanks. Yeah, I think every developer will be affected, but more important, whether are they affected by the so-called 3 red lines, where basically the bank's basically not going to fund you anymore. So I think that phase is really over. I think if they were to be affected, Yanlot, then it would have been it would have been already, maybe this would be like a 1-2 years ago. So I don't think they are affected. More right now, again, this is our a bit contrarian view, is that the sentiment is as bad as it can be, because the top developers in China is all going bankrupt, right? So I guess if you're a bit more contrarian, this would be the step, since I guess competition is also going away because no one has the ability to purchase land except those with strong balance sheet, and of course more important with bank support. So probably Yanlot is one of those, because you can see them rebounding, but they are going to announce a results briefing on Friday, so maybe we can give more color, especially on the financing part for them. Yeah. CapitaLand China Trust, they're not a developer, so they may not be affected, but I'm really not familiar, but of course they're going to be affected by any lockdown, because there's basically nobody going to your mall. So then they might have to give rental rebates. Again, I'm not familiar because I haven't been to their briefing, so I apologize. I can only give very macro, like newspaper information, which is very limited value anyway. Yeah. What is your take on Baba in Hong Kong? I really not familiar. Sorry, I don't know much about Alibaba, so I have to skip that. Hi Paul, could I ask another question, please? Raffles Medical reported a good set of results. Any thoughts on the overall medical sector? Yeah, to my surprise, I think a lot of the medical stocks can do well. I think the last time we shared some of the data, even dental numbers, I was also surprised that it also bounced back very strongly. I think May and June, a lot of the healthcare figures jumped up a lot. And Raffles Medical even mentioned GP clinics. Can you imagine that even GP clinics, which also did well? So you can assume all the specialists. I think if you want to book a slot with specialists, they're all full. So I think across the sector, I think all the healthcare have the volumes have rebounded sharply. I didn't share the specialist care, but next time maybe I will do that. Because the Ministry of Health also shares specialist care data points, so all also bounce back. So to my surprise, I think the whole medical sector, everybody's doing well. Yeah. So good time to get some doctor clients, I guess. But yeah. your thoughts on UMS and AEM. I'm positive on both, especially for UMS, because the wild card for UMS is that they got a new big customer coming up. Very top down, I mean, because they haven't released the results. The semiconductor bill chain, like I highlighted last week, will also be positive for them. Like I said, how much better can it be when the government is also buying equipment from you, and government has no P&L, they just buy for strategic reasons. I think semiconductor equipment, especially because this is where UMS and AEM is doing, the cycle I think is going to be prolonged because but it may not mean for the memory. So like for memory, like Micron, all those might be affected because they are impacted by price. But in terms of like Intel, which is mainly AEM customers, I think they can still do well because there's a big rollout of capacity now. A bit of slowdown in growth, but I think longer term, you take a 2-3 year, I think it will still do well. Then I think maybe in the 3rd, 4th year, that's where you're going to have too much semiconductors, like all things. There's going to be overbuilding, but I guess it is fun for now until when it's probably year 3, year 4, that's where the problem comes. Any view on Jardine second carriage? I haven't seen the numbers, but they are doing well because of Astra. Again, I don't have the data in front of me, so that's why I don't have a good answer for that. Yeah, why is CSE global price no movement even though they kept receiving new orders quarterly? By the way, they're announcing half year. Yeah, I really don't know. I haven't been, yeah, sorry for that. I've really never gone for their briefing. So maybe if I go for briefing, we can. Which shouldn't be, because CSE Global will benefit from the shale oil production. So if you look at the data, US production for oil is climbing back up. So they are a big beneficiary when shale oil production, not oil price, because it's the same thing, I guess, but it's coming back up. But I think this is not an issue just for CSE. I think a lot of the mid-cap names in Singapore is really not moving much. Yeah. So I don't think it's a reflection of the fundamentals or the operations. It's just, I don't know, sentiment for Singapore mid-cap names. Okay, I think that's it for all the questions. I'd like to thank everyone. Have a good National Day holiday break tomorrow. Next week, we should be able to take on some of the Singapore technical questions. So hopefully we can in the past we used to have a lot of questions on technical, like which, if you want to know what our chartist view on certain technical stocks. Hopefully next week we can do that. We'll let you know, and then you can resume asking questions on that. Yeah. With that in mind, I'd like to thank everyone for your time, especially your questions, and wish everyone have a good week ahead and a good National Day holiday break. Yeah. Thanks everybody.